The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. My name is Betsy Ricks. I'm with Blue Vault Partners, and we thank you for participating in our webinar this afternoon. Before we get started, I wanted to go over just a couple of housekeeping notes. When you register to participate in the webinar, you have the opportunity to enter your 6-digit CFP number if you would like to receive 1 hour of credit. If you forgot to do that and you would still like to get that CE credit, if you would please contact me as soon as you can at the number on your screen. It is 678-456-4640, and I will be glad to take care of that for you. We will also have question and answer session at the end of this webinar. Until then, you are all muted, and you are free to ask online questions during the seminar that I will hold until the end of the presentation, or you can raise your digital hand and I will unmute you at the end of the call to be able to ask that question. In addition, when you finish the seminar today, you will have the opportunity to take a brief survey. We would really appreciate if you would take the time to do that. We use the results of the survey from our BDC 101 webinar to help generate the content for the BDC 201 webinar today. And so we do pay attention to those survey results, and we would appreciate you doing that for us. I am going to turn it over to Stacy Chitty, one of our managing partners, who will introduce our speaker today.
Thank you, Betsy. We want to welcome everyone to this Blue Vault BDC webinar, and thank you for taking the time to register and participate. As a research firm with a heavy emphasis on education and also providing value to our subscribers, the purpose of this webinar today is to provide you with a higher level of information and training on non-traded business development companies. As most of you are aware, Blue Vault was founded in 2009 to provide fact-based research and transparency on the non-traded REIT investment offering. But last year, we decided to add to our research platform the Business Development Company investment offering. We did this by partnering with Blue Springs Capital and Jared Schneider. We consider Blue Springs and Jared to be experts in the field of analyzing BDCs, and together we launched our first BDC quarterly research called BDC Review for the second quarter of last year. And in fact, just last week, as most of you know, we released the first quarter BDC review of 2014. This was our 4th quarterly release. Jared will be leading our webinar today. We are thrilled to have so many of you sign up for the webinar. In fact, there was room for 100 participants and 108 signed up. We will be doing more and more training webinars this year and well into the future. There are financial advisors, broker-dealers, and BDC sponsors all on the call today. With that said, I'll now turn it over to Jared. Jared?
Thank you. So I want to thank everyone for joining today, and my hope is that you get a better understanding of BDCs, how they invest, and how to evaluate them compared to our overview webinar that we did earlier, which was at the end of last year, which was more of an overview of the structure and how they work and what to expect when investing in them. But for us, our goal is to get you to a point where you understand and can evaluate and compare different BDCs and how to evaluate them for your clients' portfolios. So a little bit about Blue Springs Capital. As Stacy had said earlier, we did form a joint venture in order to provide this BDC research to you. Blue Springs Capital was founded in 2012 and provides private equity and advisory services, which include direct private equity investments, new fund formation consulting, research services, and capital markets advisory. This partnership is something that I welcomed greatly, as Stacy and I and V have had relationship for several years as I was at CNL previously. So let's go ahead and get started and get you acquainted with what we're going to go over today. And so first of all, we just want to give you a quick snapshot of how the BDC market is doing and where it stands today. And then we'll be going over the actual investments that BDCs make and how to look at those and know what the terminology means. There's a lot of new terms that have come into play when looking at these investments. They are a new investment, a new alternative investment, being that the first BDC, non-traded BDC, came about in just 2009. So as a newer investment, there are a lot of new terms to go over. Then we'll move on to comparing BDCs. So, we talked a little bit about the metrics to look at in our previous webinar, but what we want to do is to take those metrics and to take different aspects of the performance of these funds and explain to you how to compare them from fund to fund so you can make the right decision when it comes to allocating capital. And then we'll talk about benchmarking BDC performance. So in that, we haven't been able to find the appropriate benchmark in the past for BDC. Quick update of the BDC market. There are currently about $10.4 billion in assets under management of both closed and open funds. There are 9 funds that are active raising capital currently, and almost $5 billion in new equity was raised in 2013. And that is just an astonishing accomplishment when you think about the age of this industry, as it is fairly new. We expect that the capital raise will be over $6 billion this year, with $1.5 billion being raised in the first quarter alone. So it is going at a run rate, and a growing one at that, of about $6 billion. So, and another thing that we'll talk about is the performance numbers and total return numbers of BDCs. And on average, BDCs provided a total return of 11.2% in 2013, which is very impressive when you think about what these funds are actually investing in. And going back to the benchmark portion, the average fund outperformed its relative benchmarks by anywhere from 4 to 6%. So that is much better than investing in those individual indexes. And another exciting thing that's happened in 2013 is in April, Franklin Square listed their first BDC, FS Investment Corp., listed under the New York Stock Exchange under the symbol FSIC, which was a successful event. But even more important is the fact that they have proved that this model, from going to a non-traded structure and then providing a liquidity event, can be very beneficial for investors, and they have provided those returns to investors. To an idea of how the assets and capital raise has been laid out for this year. In the first quarter, you can see the capital that was raised in that right column. So just with Franklin Square, they've raised over $800 million in the first quarter, followed soon after by Business Development Corp of America, and then so on. So you can see that these capital raise numbers are significantly higher than they've been a year before and the year before that. So you are seeing a growing trend of capital going into these investments. And these funds, as they stand, are becoming quite large in perspective of the publicly traded BDC market. The largest publicly traded BDC sits around $5 billion in assets. And then, as you can see, a lot of these funds are coming close to that range. And I would say that the average traded BDC out there has about 200 to 300 or 400 million dollars in assets. So significant accomplishment for the non-traded structure. So now we can talk about the investments that BDCs actually make, and I won't do a broad overview, and we really want to dig in and get under the hood of some of these investments. So just to quickly tell you, I'm sure a lot of you know that BDCs can make either equity or debt investments in private companies in the U.S. At least 70% of their portfolio has to be allocated that way. But most non-traded BDCs currently are focused on debt investments. And then you go back to the capital structure, which we have a graph of on the left, and that basically just shows the different tranches of a company's capital structure that you can be invested in. So, from senior debt with the highest priority all the way down to common equity are places that BDCs can allocate their capital within a private company. So the next item that is becoming a hot item, something that you might hear out when you're hearing about BDCs, is the buy versus originate component. So origination is becoming a bigger issue with BDCs, and a lot of BDC managers propose that you have a better advantage and better performance when your portfolio is full of originated loans. And basically what that means is, so when you're out buying a portfolio of loans, what happens is a bank or another financial institution or some group might offer their loans that they've made on the secondary market. So now those loans sit on the secondary market, and a fund like a BDC can go and purchase those loans. So you're basically buying that loan that's already been written, already underwritten, and already been originated, and so you're just buying and participating in the interest payments that come from it and any discount that you might buy the bond or loan out. So the other way that BDCs put debt in their portfolio, or debt investments, is through origination. And so the origination portion is that the BDC itself is acting almost as a bank. So what they do is they take their capital, they look at a company, they have a relationship with this company, and then they decide on loan terms for this company. So they decide to lend a certain amount at a certain term, at a certain interest rate, and they define the terms. So that's where the benefit comes in. If you have a really good, experienced BDC manager, investment manager, then there can be significant benefits of origination. Now the issue with origination is that typically it's much easier for a BDC that is larger in size to make originations. So as you're growing, let's say you have $150 million in assets and you want to originate a loan, and maybe that loan has to be $50 million. For you to make a $50 million loan, that would be 30% of your portfolio. So you might want to wait and just purchase loans that are on the secondary market until you get to that size where you
hear me, we apologize for the music interruption. We're trying to identify where that is coming from. If you will please be sure and put yourself on mute on your end so we can isolate the situation. Thank you.
You know, you hear different terms when it comes to debt. You hear senior debt. You hear first lien, second lien, subordinated debt. What do all those mean? So senior debt as a whole is a lot of times secured by assets. So typically you'll find that any senior debt is secured by an asset. That's not always the case, but you might hear the term first lien senior secured. So in a portfolio, BDC might be promoting that they have first lien senior secured loans, and it's a significant portion of their portfolio. What that means is that by having that first lien, they get paid before anyone else does in the event that anything happens to the company. And in addition to that, that lien and that debt is secured by specific assets in the company. So if the company has certain property, plant, and equipment, then those assets are backing that loan. So let's say, for example, a company goes out of business and they sell off their assets. They have $50 million of assets to sell off, and they have a $50 million first lien loan and then a $50 million second lien loan. Well, if they only get $50 million for their assets, then that gets paid to the first lien holders first. And then if there's anything left, it goes to the second lien holders. But both of those liens are or come before any subordinated debt. So a second lien holder is still a high priority in the capital structure because it's still senior debt. They just come in right behind whoever is holding the first lien. So, and then you move down to subordinated debt, and subordinated debt is typically unsecured, has a higher interest rate, and is typically fixed rate. So, for example, any kind of high yield bond acts like subordinated debt. So, in theory, your subordinated debt will be a higher fixed rate, and then your senior debt will be a lower but floating rate. So, and I use that as a general rule of thumb. That's not always the case, but that's typically what you'll see in the market. So there's another term that you might hear that a lot of credit investment managers use. Some of them will originate or buy into unitranche loans. And basically what that means is they invest across that structure of debt. So looking at senior debt and subordinated debt, you know, a company or a fund might want to come to a company and be the solution provider for their debt. So let's say this company needs $25 million in senior debt and needs $10 million in subordinated debt. What that fund can do is go to that company and underwrite all in one transaction, in one contract. They can provide both of those structures of capital. So that's a term that you might hear when it comes to origination, because sometimes that is a way to win the business, if you will, and also provide more of a solution to the company. So we'll move on to how do you compare these BDCs. So instead of just knowing the metrics and knowing kind of what to look for, really what you want to do is make the best decision, right? So if you're looking at several different BDCs and you say to yourself, which one is the best fit for my client's portfolio? Well, here are some things to look at. So we'll go over investment strategy, performance, and distribution payout. We'll go over leverage, concentration risk, how concentrated is their portfolio, and there's two different. So investment strategy refers to the way that the fund actually invests and its investment objectives. So an example of this is there might be a fund out there where they say that they invest in lower middle market, which they define as under $50 million in EBITDA, senior secured debt, and all industries. So what that means is when you're looking at this investment, you say, do I want to be exposed to lower middle market companies? Do I already have exposure there? Do I want to move up to a higher middle market? Or do I want to go larger? Or do I want to be participating in some subordinated debt? Or do I want to be focused in one industry? So the things you want to look for is, what is the average size of this company's portfolio? Are they really staying within that lower middle market? And make sure that their portfolio really is senior secured debt. And if they're investing in all industries, something that we'll talk about later is the concentration risk. You want to make sure that they are actually investing in a diversified group of industries. And then you might hear this, which is very similar to a lot of non-traded REITs out there. The investment objective is to provide current income and to a lesser extent capital appreciation. And that basically means that they are just trying to provide current income on usually on a monthly basis. And then the capital appreciation part is just kind of a bonus if it happens. But typically with a debt investment, if you think about it, you want to get your principal back and then you want the interest payments. So those are the only things that you are concerned with as a lender. Moving on to performance and payout. The first part of performance is the total return. So BDCs are required to show their total return numbers, and what that means is their distributions based on a DRIP program. So if those distributions are reinvested, plus any capital appreciation that happens from the NAV, the net asset value, equals their total return for that period. So if you take a look down below at this chart, this table here, you see in 2013, Business Development Corp of America did 14.12% of total return in 2013. What that means is for the year, they did that amount in performance, but the way that we report on a quarterly basis is year to date, and that's unannualized. So you look at the year-to-date numbers, and they look lower, but that is the pure total return number of the first quarter of 2014. So as you read down these, this is just for the first quarter. So the next thing that you want to look at is the portfolio yields. So you've been able to distinguish total return based on NAV across different funds and compare that. And now you want to look at the portfolio yield. So how well does the portfolio perform as a whole? Your return on equity number is really what are the total earnings on your equity. So the number that is called net change in net assets or net increase or decrease in net assets, it's explained a little bit different in each filing, but what that number is it's like your net income. For an operating company, it's your GAAP net income number. So the return on equity is just comparing that number with the equity for the company. And then you move on to yield on equity, and what that is, that's a measure of the total yield, the total investment income that's coming into the fund from interest payments versus the equity outstanding. So that is basically a levered way of looking at the income that's coming in on each of your dollars invested. And then you move down to yield on portfolio, and what that is it's the total investment income. It's those interest payments coming in from the loans divided by the total investments in the portfolio. So that's a way to look at the yield, the average yield that it's getting on its portfolio on an unlevered basis. So you're looking at all the loan holdings that the BDC has, and you're getting an average yield number on what they're getting. So on average, in this fund's portfolio, they're earning 9.6% annually as a form of interest income. So that's a great way to compare the actual performance of the portfolio itself. And then, of course, with distributions, you want to make sure that the sources of the distributions are appropriate for your investors. So if the income focus of the BDC is, or if the focus of the BDC is to provide income, then you want to compare the income that's coming into the fund itself. So the number that you want to look at most intently is the net investment income number. And what that is that's all of the interest payments, all the investment income that's coming into the fund, less all of the expenses. So that's basically what's left over to be paid out as a form of income to the investors. So as you can see here in Q1 2014 for this particular fund, 59% of the distributions came directly from net investment income, and the rest came from capital gains. So this is a good, this fund is fully covering the distribution. However, the thing that you want to look for is you'd really like that net investment income to be covering as much of that distribution as possible. And so what you want to do is watch this fund to see if that net investment income will come up, because the capital gains, it's a nice way of paying distributions, but you can't count on that every single quarter. So capital gains are going to go up and down based on how certain things appreciate and depreciate in the portfolio. And the investment income should be a consistent payment every single quarter. So that's a way to evaluate the actual distributions that are being paid out. And then when it comes to actual payout ratios, so with non-traded REITs you have an FFO payout ratio, and there's nothing that's exactly the same on a calculation basis, but you can get to a close number with BDCs. So with BDCs, just as non-traded REITs, you want to make sure that that coverage is coming as close to or under 100% based on this certain number. So this certain number is taxable income payout ratio. And what that does is your taxable income is the closest number that you can get to as cash earnings. So you want to compare your cash earnings with your distributions that you're paying out. So it's the simple calculation is distributions divided by net taxable income, and that brings you to 94.5. So that means that this fund is earning more than it pays out, which is a great sign. So this next number is a little bit less important because it's based on a net income type number, that GAAP earnings number that I talked about earlier. But it is useful to know what they're earning in comparison to their distributions. And as we all know, a lot of GAAP earnings numbers are not necessarily cash earnings. So it's just it's another comparison point. Let's move on to leverage. Leverage has not really been a problem in this industry, and I'll talk about, there's two reasons for that. And really that's just the total borrowings divided by the total assets. So it's something that needs to be monitored, but it hasn't been a problem. And the reason for that is twofold. So one, the investment managers themselves have been conservative in adding leverage to the portfolio. So they're borrowing some to make more loans, which helps the returns and helps the income as long as you borrow at a low enough rate. You'll see average leverage ratios in the range of 20 to 35%, sometimes lower. And then the second reason that you don't see high leverage ratios within this industry is because currently they're limited at 50% leverage by regulation. So there is currently proposed regulation to increase that amount, but it has not been passed. And so as it stands, they're currently limited to the amount of leverage that they can put on the portfolio. And this number does include what you might have heard of, maybe not. There's an off-balance sheet item called total return swap, or TRS, which essentially increases the leverage without having the exposure of owning the actual portfolio. And I know that sounds confusing, so we'll go through it a little bit. Total return swap is basically an agreement with a financial institution like a bank. So a bank like JP Morgan may hold a portfolio of loans. And what they do with that portfolio is they hold that out for a group like a BDC. And the BDC can say, I want to participate in all the capital gains and income that comes from that portfolio. And then all JP Morgan wants back is an interest payment. Every quarter they get an interest payment in order to allow them to use that portfolio for capital gains and income. So some benefits of that is that it adds interest income and capital gains, which basically juices the returns for investors, which is a good thing in good economies. And the leverage can be increased and decreased relatively quickly. So if you think about it, if you make a lot of loans and they're all outstanding and you have borrowed some to make those loans, in order to decrease your leverage, you either have to sell those loans or make them pay them back or have them paid back, and that is it's a very slow process. So with a total return swap, you can basically draw down the amount that you're exposed to, which allows you to decrease your leverage if you think that the economy is slowing down, or if you see other things on the horizon, you can decrease your leverage a little bit quicker and just allow some more flexibility. The other thing is that the advisor cannot take fees on the TRS performance or the amount that is in the TRS. So the performance basically passes through to the investors without incurring additional fees, which is nice because you can add return to your portfolio without hurting the investors. So that's a very good thing. Now the next way to compare these BDCs is you want to look at concentration risk. And as I said, there's two different ways to evaluate that. And you want to look at the industries and how concentrated the portfolio is within those industries. So some general rules of thumb are you want to look at their portfolio concentration, and more than 10% in one industry is something to look for, but it's not necessarily a concern. But once you get to 20% or above in one industry, and this fund is supposed to provide diversification across industries, then that is starting to become a significant concentration in one industry. So that's something to look for when you're comparing these BDCs is there one industry that they are overly concentrated in, and do I want to be exposed to that? Now the next part of the concentration risk is the company concentration risk. So in the portfolio, having more than 10% of the portfolio in one company or 1/10 of your portfolio in just one single company, I would say it could be a cause for concern, because what you're trying to do with a BDC is get current income the way that most of these BDCs are now. You want current income based on a diversification across different loans from different companies, and if it is a diversified industry-wise, then across different industries. Now, some BDCs may specialize, and a good example of that would be FS, Energy and Power. So what they are doing is they are focusing within the energy and power sector. So obviously 100% or close around there will be in energy and power, which is to be expected. And that's a judgment call that you have to make on, where you want that capital allocated. That all goes back to evaluating these specific investments for your client's portfolio. Now, the next part of evaluating these and comparing is the interest rate risk that lies within the portfolio. So the interest rate risk is something that it's caused by overweighting in one interest rate type over the other, given certain interest rate environments. So an easy way of understanding that is if your outlook is that interest rates are going up, you want to be in floating rate loans, because if interest rates are going up and you're locked in at a lower rate, then you're not getting a return above the current interest rate market. So a way to hedge that risk is to be in floating rate loans. Now, if the flip side happens, if you think that interest rates are going to go down, then you want to be more in fixed rate loans. So, if it's 8% current interest rate and you lock in that 8% and the interest rate environment goes down to 2%, then you're doing pretty good because you have this 8% coupon when everyone else is getting 2%. So that's how that relates to your specific outlook or your firm's outlook on the interest rate environment. And something that's been happening over the past year and a half within BDC's portfolios is that you've seen this shift into much more overweighting in floating rate loans. And the reason for that is, as a lot of you probably expect as well, they view that the interest rate market will increase soon. So somewhere in the near term, interest rates are going to go up. We're at all-time low interest rates still. So that's something that BDCs have done pretty much across the board in preparation for the interest rate environment. So the last thing that I'll talk about as far as those 6 things to look for and compare across BDCs is liquidity. And the liquidity provision for most all BDCs is the same, but this is something to just educate you on in case you are coming from a non-traded REIT background and you're not really sure how the liquidity works. So liquidity is obviously, it's an issue with any non-traded or illiquid investment. We all know that. So non-traded BDCs typically will have a limited liquidity of about 5% per quarter. And they do that through tender offer programs. So at the end of the quarter, they will strike the NAV price, so the net asset value per share, and then after that, they will offer shareholders a certain amount to sell their shares, which is called the tender offer. So it allows a little bit of liquidity at the end of each quarter, and a lot of times you'll find that the traditionally structured non-traded REITs don't offer this much liquidity. And there are new forms and new structures out there, but this typically provides a little bit more liquidity out there. So much like the non-traded REIT market, a liquidity event typically is expected within 5 to 10 years of the fund's operation, and that is through a listing event, selling a portfolio, or merging with another company. So those are things that are typical and have been around for a long time in the industry. So the last thing that I want to talk to you about is benchmarking. So we talk about these total returns, we talk about how to evaluate performance, and I've talked to you about how the total returns are based on NAV and DRIP and the combination of that. And 11.2% is a good return, but what do you compare that to? So do you compare that to the stock market? No, because the BDCs are not investing in public equities. Do you compare that to the public bond market? Not necessarily. Some of the BDCs have some exposure to it, but that's not the majority of what they are investing for. So what do you look at? So a couple of benchmarks that we have found to be the closest comparison to performance of these BDCs. There's no one index that really comes close to comparing the performance, but you can look at these two benchmarks. So there's the S&P LSTA Leveraged Loan Index. And what that is a measure of what are called leveraged loans or bank loans, and it measures mostly senior floating rate debt. And so that's where that part of the portfolio, so if a BDC is largely invested in senior floating rate debt, then that's probably the closest measure. And then there's also the Bank of America Merrill Lynch High Yield Master Index. And what that is that's a measure of typically subordinated high yield debt. So if the portfolio is more weighted that way, then that's probably the more appropriate measure. But most all of these funds, with the exception of 2 or 3 of them, have a combination of the two types of debt within the portfolio. So just to give you an example of how we compare across funds and across the benchmarks is we'll have a comparison table like this above in our reports, and it shows the total return performance, and then we show the benchmark comparison, and then we do the average and the median performance of each of those funds. And as I said earlier, a lot of these funds, or on average these funds, outperformed by anywhere from 4 to 6% of their benchmarks. So you take a look at, for example, the Leveraged Loan Index, the total return there was 5.25% for 2013. And that is over 3%. There's over a 3% difference in the lowest performing BDC out there. So I think it's a testament to BDCs and their managers that they are able to outperform these indexes, and also to appropriately add leverage to the portfolio, because some of that return is because of the leverage that's added. But there are no funds out there currently that I would be concerned with as far as their leverage ratios. So we'll move into the question and answer session, but I want to express to you gratitude for joining, but also I really hope that you got a better understanding of these BDCs and how you compare them and how to make the right decision on making an investment in one or several of these. So we'll move on to the question and answer session, and I believe Betsy will take it from here.
Thank you, Jared. Jared, I don't think you're aware, but at some point during the presentation we had a lot of overplaying of music, and so you were coming in and out in some portions. So we've had a request to go back and revisit the slides on origination. Can you go back and cover that portion of your presentation again?
Sure. So on the origination versus buy, I'll just kind of go over that whole section again. And what happens in that is you might hear origination, you might hear that we invest in different deals or club deals, which is kind of a hybrid between origination and buying. But what happens is you can either go out as a BDC, you can go out and buy loans on the secondary market, which are typically loans that banks have already made or another financial institution or another group has originated. So they might originate a loan, and to move it off their books, they'll sell it to the secondary market. Or someone owned it previously and needed liquidity, so they sold it. So usually early on in a BDC's life cycle, they will have to do that method of getting investments into their portfolio. And the reason for that is because with origination, a lot of times the dollar amount is high that you need for origination. So if I have only $150 million in assets in my portfolio and I want to originate a $50 million loan, that's going to end up being a third of my entire portfolio for that one loan to that one company. So what I would want to do is diversify my portfolio by buying several different loans or several different pieces of different loans, and then waiting until I have enough in assets to originate new loans. So 50 million, if you have 5 billion in assets, is not as much of a chunk of the portfolio as if you have 150 million. So, and then going to the argument of origination is better, which is something that you might hear. It can be better, and the reason for that is that if you have very experienced and capable investment managers making these decisions and underwriting the deals themselves, you can write your own terms, right? So you have a relationship with a company, and with that company you make a loan and you define the terms. So it can be very beneficial to the portfolio, and you're adding new capital to the economy. So so it can be a great thing. The flip side of that is that when you buy loans on the secondary market, they've already been vetted and underwritten and originated by a very experienced team. So, you know, any major bank out there is originating these types of loans, and it's easier to evaluate them on a performance basis because they have a performance history, you know, payments, if any covenants have been tripped. So there's more history and underwriting experience behind that if you're compared to a new manager. So if you're an experienced investment manager making those origination deals, then you can see a lot of benefit to the portfolio. So that's the thing that you want to look for. If they are originating a lot of debt, who is it that's underwriting those deals and that's originating that debt? So I would say that yes, it can be beneficial to the portfolio, but origination ultimately ends up as a measure of the capability of that management team. Does that help clear up the origination aspect?
I think so. If it doesn't, if you'll just let us know that you want us to go back and cover some more specific areas about that, we'll be glad to. Gary Justice is talking about portfolio construction, or I'm sorry, portfolio concentration, and asking what are diversified investment vehicles?
So a lot of times those can be funds that are set up. They can be private funds that invest in different credit securities. So they could be doing their own loans. They could be doing different types of debt instruments. I believe that it can include collateralized loan obligations as well. So basically there are other funds or other structures that are exposed to different types of debt.
All right. Andy Rainey is asking, how do you tell what percentage of each BDC is purchase loans versus origination?
It is typically found in their annual or quarterly filings. Not every BDC reports the same way when it comes to things like that. So, but for example, you might find in, I believe, Corporate Capital Trust and Franklin Square's funds, they actually show a table that says what percentage of their portfolio is originated versus bought or club deals. And as I said before, club deals are kind of a group of investors coming together to make that loan. So it's kind of a hybrid between buying a loan and originating a loan. So so that can be found a lot of times in the 10Q or 10K, but it's not always expressly reported. So it's one of those things that you kind of have to dig to find.
All right, I have a question from Jay Steigerwald. Why wouldn't the leverage be higher given the low cost of money now?
Well, I think a lot of BDCs have been conservative when it comes to levering up their portfolios. And as I said before, you are limited to 50% leverage. Some of them, I think, are kind of waiting to see where the credit markets go. And I think the other part of it too is, I think they just are being conservative when it comes to levering up. So, you have seen, you are right that the interest rates have been extremely low that they're paying out. So their spreads are still very significant, even though it's not overly used.
All right, another question. How concerned should we be about fees? How standardized is the fee structure?
So the fee structure is pretty standard. You'll find most of them are under the kind of 2 and 20 model, which you may have heard. It's used a lot in the alternative fund space. Some are as low as 1.5% annual management fee, and then a lot of times it'll be that 20% on capital gains and income above a certain hurdle rate. So, and then on the other hand, if you look at kind of the commission side of fees, they're all pretty close to the same range of that 10% maximum upfront load.
All right, this is back to the club deal. A club deal is still considered a loan origination since they share in the origination fee on a proportional basis. Is that correct?
Yes, so there will probably be a lead underwriter in that group. So let's say there are 4 groups participating in this club deal, and one of them will be the lead underwriter or originator typically, and that group will receive a larger portion of the fees, but yes, they can share in all the fees and kind of all the benefits of origination within that.
All right, we're going to take a verbal question from Scott Polo. Scott, I'm going to unmute you, so you let us know what your question is for Jared. Yes? All right, I'll come back to Scott. Let's take another written question. He said, I may have missed this, but what are some of the risks to a total return swap? He said, I caught the benefits.
So as far as the risk side, I guess it's really that you may be going into a group of loans that you necessarily aren't watching as closely. I can't say that across the board, but you don't get to pick and choose, what's in that portfolio on a, you're not in there originating those loans, so you may not have as much control when it comes to the exposure that's within that portfolio. And as far as other risks, I can't really say that there are too many others, but it is a significant leverage use. So you're typically putting up maybe 20 or 25% of the capital that is needed to cover that entire portfolio. So if you're getting a $100 million portfolio, you might only put up $20 million, so you have to put up a certain amount of collateral to get that portfolio. So in that sense, it is pretty leveraged, but the overall leverage is not, does not affect the entire fund.
All right, can you discuss your thoughts on the Franklin Square listing? Was it successful? Also, do you anticipate more BDCs to list publicly in the future?
To answer the last question first, I do think that more BDCs will list in time. It's a very logical exit for these BDCs, and you get to continue to have the management team manage that portfolio. So if you continue to like the BDC that you're in, and you can have that liquidity if you want it, but you can continue to have that management team manage that portfolio. So with the Franklin Square listing, for example, Franklin Square and GSO are still managing that portfolio. So it doesn't go off to someone else once it lists. They're still watching over that portfolio and still making new investments, actually. So I do think that that's something that will continue to happen. I think that FSIC's listing was successful, and you have to remember too, there wasn't a huge capital appreciation upside at the listing, but you have to think about what they're investing in, right? So you're investing in debt and in loans, and when you make a loan, what do you hope to get back in return? You hope to get back interest payments and then your principal amount. So there's not the capital appreciation that you might find in equities or in real estate or whatever that case may be. You're just not going to get that capital appreciation unless you bought loans at a very steep discount. You're not going to experience a huge capital appreciation. So what they did is they performed on what they said they were going to do. They provided that current income and provided a return of capital to their investors for a fair return. So I do think it was successful, and I just want to kind of set the tone for the way that the liquidity event happens with a BDC is you probably won't see a huge uptick in the actual price unless the market as a whole is really roaring, or all BDCs as a whole are trading at a very high premium to their NAV, which is something else that we can talk about at another webinar possibly.
All right, how frequently is NAV calculated, and what is the calculation based on?
So NAV can be calculated as frequently as, I believe, daily. It is usually struck at the end of the week or at the end of the week when new capital comes in, so at least every 2 weeks, and then it's published as it changes significantly. And then the way that it's calculated is basically they take all of the assets less the liabilities, and that provides your net asset value. But how they're actually valuing those assets in the portfolio is there's a few different levels of how you calculate the value. If it is, for example, a loan that's traded on the secondary market and you can easily look up the price of that, then it's easy to value, and you can take that directly from the market and you just input the price. And then there's a couple of steps down which go all the way down to you are basically coming up with, or the BDC is basically coming up with a valuation methodology for valuing this particular investment. And they will actually disclose how they came to that certain number. So it is something that can be, I guess you could view it as arbitrary when it's, for example, like an originated loan or something like that. But they are being transparent in how they value it. So you can actually look through their filings and see how their calculations are run.
All right, can you go back and address a little bit more about fund operating expense ratio?
Yeah, so the fund operating expense ratio is it's something to look at, but it's difficult to measure as far as a total number, and the reason for that is because that includes all of the SG&A expenses. So if you think of the BDC as a company, then the company, let's say you have a 5% operating expense ratio. The company may take 2% to manage it, and then you have other miscellaneous administrative fees and whatever else. So that total dollar amount as a percentage is reflected in that operating expense ratio. So that includes the 2% management fee. It includes all the other fees to run the fund itself. I would say that you want to watch and make sure that those are coming down as assets are growing. Obviously, at 2% of management fee, you're not going to see that number be lower than that. But all the other administrative expenses as a percentage of the whole should go down over time as the fund grows in size. So you just want to monitor that number. And I would say that a rule of thumb kind of number is you want to see 5% or lower, and it could be slightly around there. But when you're above 10%, then either the fund is really new or they're not being economical with their expenses.
All right, this person said, I don't know if I missed this, but can you please speak to the benefits of exemptive relief?
So I didn't go over that in this. Exemptive relief basically is just, it's something that the BDCs will do through the SEC. So you apply for exemptive relief if you want to invest alongside an affiliated manager's investment strategy. So, for example, if BDC has a sub-advisor and that sub-advisor has other funds that they have other investors in, and the BDC wants to invest alongside those investors, in order to do that, they have to receive exemptive relief from the SEC. So it's basically just a declaration stating that, yes, you may invest in the same investments alongside these other investors in this affiliated company's funds.
All right. What are the advantages of a non-traded BDC versus a traded BDC?
Well, that goes back to the the non-traded structure as a whole, and what that structure provides for investors is the non-constant volatility of what you see in the stock market. So it provides somewhat of stability in your price and your value, because traded BDCs can trade at a very low discount to their NAV or a very high premium. So they can trade way above and below what they're actually worth in value. And that is something that doesn't happen with the non-traded BDCs because their offering price is inextricably linked to NAV. So you're always getting in at or near that value. So you're not experiencing these large waves of up and down on the NAV. The other part of that is a lot of times you'll find that the non-traded structure will provide monthly income distributions as well as significantly higher ones. So there could be BDCs that have higher yields, but they may be also taking more risk. but the non-traded typically have a yield from anywhere from 6 to 8%, and that is fairly consistent throughout the life of their fund. So those are some of the benefits of that structure.
All right. Are the benchmarks you mentioned for the traded market? And if yes, how is that a good comparison? How is that a good comparison?
Yes, both of those benchmarks are for secondary markets. They might not be as widely traded, but really the reason for using those is because it compares the loan types that are within that. Otherwise, there isn't really a good benchmark index. So as I said before, it's not a perfect comparison, but it is the closest thing that we have to compare to.
All right, this was a topic, Jared, that I think was skipped over when we had the musical issue. Can you talk about CDOs?
Yeah, so those are a packaged security of loans. And so the CDO, which means collateralized debt obligation, or collateralized loan obligation, is CLO, which have their nuances, but they're pretty much the same in structure. So it's a packaged security of different loan obligations. So you might have a CLO that has loans from different companies, and it might be senior debt, subordinated debt, whatever. It might all be packaged together into one CLO, or you can buy certain pieces of that. But anyways, what you're getting with that is something that is like origination, in the fact that someone underwrote those, so a bank or another financial institution may have made these loans to a group of companies, and you are getting to participate in that. And it just gives you exposure to a diversification of companies as well as different tranches within the debt structure. And really, I would say one of the reasons that it is becoming a growing investment is because it is hard to come by those relationship-based proprietary loans that happen, from BDC to company. So those are a harder thing to come by in this market. And so the ones that have the relationships may originate them, and then you also get the backing of that group that originated it. So if you value whoever originated the CLO and you believe that they're experienced and capable, then buying that CLO from them may be a beneficial way to participate in those interest payments.
All right, is it typical for BDCs to use an independent valuation firm or an auditor to value the NAV?
I'm actually not sure on that. I believe annually they might, and then quarterly they do it internally, but I am not 100% sure on that.
All right, can you speak to why Franklin Square has exemptive relief amongst the Franklin Square funds and not so with GSO, and that CNL as well, CCT has exemptive relief with KKR, and any benefits for either BDC?
Yeah, so I would say that the short answer to that is because they applied a long, long time ago, because it takes a very long time to get exemptive relief. But seriously, the exemptive relief does provide that ability to invest alongside. So let's take GSO, for example. They manage billions of dollars for institutional investors, for pension funds, for university endowments, for large, sophisticated investors like that. And what they do is they make those investments in these private funds. And the exemptive relief allows GSO to allocate some of their investment through the BDC into the same exact investments that they're making for those institutional investors. So for an investor to hear that, you know, I'm investing alongside GSO or KKR or whoever it may be, you know, there's a certain amount of reassurance, and you know, it is, for lack of a better word, I would say that it's cool that you get to invest right next to these large institutions that are paying these managers very well to find these investments for them. So you get to invest and participate right alongside them.
All right, one of the BDCs was given an investment grade rating from S&P. Do all BDCs get a rating from S&P? And if so, can you please review this?
Yeah, so the investment rating you actually, as a BDC, you have to pay for. So you have to pay S&P to rate you. So not all of them do get rated. And S&P has also stated that they will not, I believe they will not go above a BBB rating on BDCs based on their investment types and investment strategies, and they have their reasons for that. But no, not all of them get rated. And basically, the rating part of it is to just give some reassurance within the respectability of the investments.
All right, we've only got one more question, so if you are thinking of something else you want to ask, if you could please go ahead and submit that now. Jared, our last question right now is, how would an advisor feel confident about the NAV reporting for non-traded BDCs? Since the accounting performed by third parties, NAV reporting paid by the BDC sponsor.
Well, and that goes back to the fact that they are public companies, and under audit requirements in Sarbanes-Oxley, they are required to have independent accounting firms come in and audit them. So it really comes back to the transparency and trust in the fact that they are public. So they're holding themselves out to the public and putting themselves under the requirement to be diligent and transparent. And I think that's something that is a lot of times missed when looking at a non-traded public product versus a private product, because a private fund does not have to have any of those same requirements that a public structure does.
All right, we do not have any other questions at this time, so Jared, we appreciate that. I'm going to turn the call briefly back over to Stacy Chitty, and then we will wrap up for today. Stacy?
Okay. Thank you, Betsy. Guys, I do want to apologize. I don't know exactly who all heard the music and who didn't. I certainly did, and at least a few others, but we'll find out what went wrong here and not let that happen again. We apologize. We want to thank you for your participation today and for entrusting Blue Vault to help keep you informed on the performance of every non-traded REIT and BDC. We hope it was informative, and we hope that you learned something that you didn't know prior to the call, which helps add value to what each of you do every day. We hope you'll join us again as we continue to provide educationally based webinars throughout 2014. If you have any questions following the call about BDCs, please feel free to call us at 877-256-2304. And just a side note here, as many of you know, Blue Vault is the only research firm to conduct and release now 2 different unprecedented studies on non-traded REIT full cycle performance. These have been 27 total full cycle returns. We will release the 3rd edition of this study with many more full cycle returns later in the fall, so be looking for that all FA subscribers receive these studies as part of their subscription. And I think that it's important for everyone to know on the call that as a participant on the call, you are on the call because you are a subscriber. We will always prioritize what we do towards our subscribers. Every now and then we will have a webinar, educational webinar for those who are not, but 8 times out of 10 it will be for our loyal subscribers. So we appreciate you very much. And with that, we thank you and hope you have a great day, and this ends our webinar.